Hey guys, this is Rudy coming at you live from Palm Beach. I'm back in Palm Beach, Florida. I've been away obviously for a few weeks. I spent some time at the Swiss Mining Institute, which was in Zurich. I met some small cap miners there, about a couple of dozen or more of the CEOs and COOs and people like that from mining companies from across the world. In a future video, I'll share some of my top picks with you that you could probably add to your watch list. What I want to do today though, is address some of the conversations and communications and comments on our YouTube channel, which were posted during my absence. And of course, Mayday, 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 or as I used to say in days gone by, one Maserati, two Maserati, three Maserati, as we keep losing money for our investments in energy. Well, I'm smiling. I'm not sure why, but hey, you know what? At the end of the day, it's not necessarily all bad. And what I want to do is go into a presentation that I prepared for you guys. And if you give me a second, I will just call it up here on my screen and share it with you. So just give me a moment here. Let me just share this with you and we'll go from the beginning. And okay, so here we go. Right. So first, just to kind of set the stage, the 620 exajoules in the middle is the consumption required in the world today. And if you add up coal and oil and natural gas, that's about 80% of the 620 exajoules. And if you include nuclear energy, then you go up to about 85%. Nuclear should actually grow. The rest of the renewables and other energy that we are generating, with the exception of hydro, is relatively insignificant at this stage, regardless of the fact that just the European Union alone has invested actually Germany alone has invested almost 200 billion euros in renewables over the past few years, and they still pretty much have nothing to show for it. Well, this is kind of the backdrop, right? But what I want to do is get into the presentation here, and I specifically want to talk about these five stocks. Now, we've talked about them many, many times in the past, and so they're all going to be familiar with you. And I know some of you have position in these. Joe Huerta has asked me a couple of times to catch up on Devon and Occidental specifically. But what I want to do is sort of a five-way comparison here between five of my stocks that I've talked about previously in the past. Currently, I only have positions in two of these, and that would be Energy Transfer and Alliance Resource Partners. But let's go through them quickly, right? So Alliance trades on the NASDAQ. It's the odd one out there. There are the other four on the New York Stock Exchange. The other odd one out there is Petrobras because it's an ADR, which is an American Depository Receipt. But then if you look at the bottom here, where I've put the green arrows, you'll see that the industry is not the same, right? So these things are similar, but they are not the same. Alliance Resource Partners is a limited partnership, which complicates your taxes a little bit if you're a US tax person, because you have to file that limited partnership earnings. It's a coal company. And the reason why I include coal is because, as I just showed you a minute ago on the previous slide, coal is still uh, arguably the one of the largest resources that we use for generating electricity. In fact, even in Germany, which I referenced briefly at the start, about 38% of their energy production is coal, and they've shut down all their nuclear, and in the process, they've destroyed all their automotive industries. It's like a terrible situation that's unfolding there. But let's look at the others, right? So Devon is oil and U.S. exploration and product, so EMP. Energy Transfer is pipelines. I have a couple of pipelines. I also have Enbridge, which is a Canadian company, but I'm not including it here for the purpose of this comparison. So I have a few stocks. So I already said I'm long in Alliance Resource Partners and Energy Transfer. I no longer have a position in the other three, but I also have positions in other energy stocks, including my ETF, which I've spoken about many, many times before, which is XLE. So Energy Transfer is predominantly pipelines. Then we go to Occidental. Occidental was my favorite going back to 2020. So that's now almost 5 years ago. And if you had followed the channel right from the inception, when I started out the YouTube channel, so around about 2020, just pre-pandemic. In fact, I started out with Occidental acquiring Anadarko. And that was kind of my genesis in terms of making YouTube videos. I said right from the get-go, my typical holding period is about 3 to 5 years. And during the 3 to 5 years, I have exited my Occidental Petroleum position entirely. And then the last one, yeah, Petrobras. So I've been in and out of Petrobras a few times. I like it for the dividend. I don't like it for the geopolitical risk. But anyway, you can tell me what you think in the comments. So these things, as I said, are similar, but they're not the same, right? So uh, Petrobras Emerging Markets Integrated. So I have coal. I have a U.S. exploration and product company, which is a combination of oil and gas, natural gas. I have Energy Transfer, which is mostly a pipeline. I have Occidental, which is U.S. integrated, and Petrobras, which is an emerging markets company. If we look at the 20-day raw stochastic, so if you've been following my videos, you'll know that I always look at some of the benchmarks because I'm looking to see whether they are a buy or not. The 20-day raw stochastic, basically very simple, in simple terms, means if it's over 80%, then it's basically overbought. We don't have any of those here. They're grossly oversold, right? So one of the stocks on here that have been oversold more than any other of the others in the energy sector right now is Devon. With a 20-day raw stochastic of only 5, but you can see the rest of them are low as well. In fact, the highest one is Energy Transfer. It's only at 30, right? So if it's below 20, it means it's oversold. If it's above 80, it's overbought. Um, none of these are oversold. In fact, some of these, like Petrobras 12 and Devon, is like when you look at the 20-day raw stochastic, it says buy. But remember, that's not all we need to look at. We need to look at more benchmarks than just one. The buy and sell opinion here is from the analysts that are covering the stock, right? So you can see, even though Devon is has been beaten down and Oxy as well, they're still 100% sell, and Petrobras pretty much the same. Everybody says buy Energy Transfer. I don't buy Energy Transfer right now. I just hold it. Same with Alliance Resource Partners. I'm just holding it. I'm not adding more. I'm only adding more when I get paid a dividend. We look at the price earnings ratio here. They're all pretty good. So now you have two benchmarks already. You have a 20-day raw stochastic for Devon at 5 and a PE ratio of 6. It's a screaming buy, but I don't want you to buy it here because even though it's trading at around $30 or so, it might even dip below where it is currently. So just be patient. And if you want to buy, maybe buy just a little bit. Don't jump in boots and all, and don't get hurt in the process of doing that. From a 6 month performance point of view, you can see Devon and Occidental have been the worst performers. Now, of course, if you had gotten into Occidental when I did, you have a cost basis of around $10 or so, and that would be okay. If you bought it later, when smart people like Warren Buffett should have listened to us, right? And should have been buying Occidental when it was 10, 12, $15, not when it was $60 or thereabouts. But anyway, I see he's just added to his position. So if you like what Warren Buffett is doing, you can always copy him and add to your own position too. I wouldn't buy it here. I wouldn't buy Devon. I wouldn't buy Occidental, and I wouldn't even buy Petrobras right now at this time. What I would buy potentially is Enbridge, maybe. And for sure, if I have money to park in energy, I would park it in XLE. I'll come back to that one in just a second, right? So from a 6 month performance point of view, you can see Alliance Resource Partners done okay, 7%, and Energy Transfer has done nicely, almost 20%. Add to that the nice big dividend. I'll come back to that in a minute as well. And you have a great stock. Petrobras, on the other hand, is down just a little, just a smidge compared to Occidental and Devon. And of course, it pays a larger dividend too. But it's unpredictable because unlike companies that pay a quarterly dividend, with Petrobras, you got to just wait and see what happens. Here at the bottom of the screen, what I'm doing is I'm comparing sales to market cap, right? So right at the bottom here, you can see Alliance Resource Partners as a market cap, market valuation. That's all the outstanding shares multiplied by the current share price of around $3.3 billion, and it generates sales of around $2.5, $2.6 billion per year. If you divide the sales into the market cap, you get 77%, which is quite normal or average, right? So again, if we look at Devon, 75%, we look at Occidental, 66, a little bit too low, but it's okay, which means either the market cap is a little high or otherwise the sales are lagging just a little bit. However, if you look at Energy Transfer, it generates 125% in sales compared to its market cap, which means it's either undervalued or otherwise they had a great year. So that's why we need to always dig it just a little bit deeper. And the same with Petrobras, right? It generates $102 billion in sales. It's got a market cap of only 84 billion, right? So if you look at these and I say Devon's a screaming buy, and you look at it from a fundamentals point of view, you might say like Energy Transfer or Petrobras look more attractive than the other three. Let's look at it on a year-to-date chart, right? So I mentioned Alliance Resource Partners and Energy Transfer have been doing pretty good over the last 6 months. How about over a year, right? So we got Energy Transfer up about 35%. It also paid a dividend of close to 8% for the year, so that's about 43%. And then we have Alliance Resource Partners up about 25. It paid a dividend of almost 10%, so it's 35%. It's pretty good. The other three, eh, not so much, right? Big negative. So you could ask me here pretty much, you could say, hey, Mr. Oxy, so now what do I do? If you are long in Devon or Occidental or Petrobras, you have three choices. You can do nothing. That's a strategy, just wait. Well, otherwise, you can buy. But if you buy, you got to be careful. Maybe just buy a little bit more. Don't jump in boots and all because you might get hurt even worse than what you have been over the last 6 months or so. Or otherwise, obviously, you could sell and exit. Um, I don't like taking losses. So if you have a low cost basis, you might say, like, I'll cut my losses and just get out. And if you take Occidental as an example, now I mentioned a couple of times we got sort of lucky on that one. And maybe your cost basis is 10, 15, $20 or whatever. You could always sell Occidental, currently trading at around 45 bucks. Put the cash in the bank. But remember, if you do that, you are generating a tax event because you're going to have to pay tax on your gains. So if you have something else at a loss, you might sell something at a loss and sell Occidental at a profit. And between the two of them, you can do a bit of tax loss harvesting by offsetting your gains on one with your losses on the other, if you wish to do so. So you have three choices. You can either buy a little bit more, or otherwise, what you can do is you can say, I'm just going to hold and wait. Or otherwise, you can say, I'm going to sell and either cut my losses, get out, or otherwise sell for a profit using my Occidental as an example. Right. So what we're going to do briefly here is look at each five of these individually. Right. So I have Alliance Resource Partners here coming up first. This is the Friday trade. So obviously yesterday we had a bit of a bounce after the big crash on Thursday, right? So Thursday was one Maserati, two Maserati, three Maseratis, and then on Friday we recovered just a little bit, not enough, but just a little bit. Anyway, Alliance Resource you can buy at about 26 bucks. If you buy this one, remember it's a partnership, so you're going to get a K1, which will complicate your taxes perhaps just a little. So you have to keep that in mind. But if it earns you a great return on your investment, then maybe you don't care to do a little bit of extra time when it comes to tax time, right? So here I have year to date up 23%, pays a nice dividend too. Some analyst recommendations on the side here, hold, or you can go long if you, according to market edge. Um, you know, I'd hesitate to simply buy now into the energy market. Everything's on a down. I'll come back to that as well in just a minute when I close off this video, because I do want to share some things with you that I've shared before, but you might have missed them, right? Why do I hold Alliance Resource Partners? Well, it pays a dividend. It's quite a nice dividend. You'll see it's consistent over the last 4 quarters, 70 cents per unit or per share, if you'd like, which is currently yielding around 10% per year. So whatever the stock gain is, you can add the 10% dividends to that, and then I just buy more stock as we go. If I go to tip ranks, I have just two ratings here that says it's a moderate buy. $30 a share is about a 14% upside from where it is right now. I'm not too concerned or too interested in that. It's currently trading around 25, 26 bucks, and it pays a dividend of 10%, and that is why it is in my portfolio. How about Devon? Man, Devon has gotten crushed, right? So just a couple of years ago, maybe not even a couple of years ago, it was trading at $77, right? Year to date, down 32%. In addition to that, the dividend on Devon is also a little bit questionable, if I can put it that way, because it's a combination of fixed and variable. Most of the analysts in general are saying, you can buy it or it's undervalued or whatever in terms of where it's trading right now. $30 is like super cheap, but don't be surprised to see Devon at below $30 within the next couple of weeks or so. And I'm going to come back to the Trump bump in just a minute before I close off this video. If you look at the dividends, it's been pretty consistent, 22 cents per share, yielding around 5%. It's not bad, right? So back in the good days when Devon was generating a lot of free cash flow and that variable dividend was much higher, it was actually generating a dividend on an annual yield basis of around 8, 9%. We look at tip ranks, it says there's a lot of upside here. That they expect the 18 analysts on average expect the stock to trade at around 50 bucks. And it's currently trading at 30, right? So if you are prepared to take a chance and buy Devon at 30 and patiently wait for it to recover, you should see $50 again. The question is when, right? We don't know. By the way, I mentioned Trump briefly and the Trump bump. Uh, the Trump concept of drill, baby, drill has not necessarily been good for energy because drill, baby, drill, by definition, means create more supply. And unless demand goes up commensurately, more supply simply means lower prices. So be very, very cautious before you jump in boots and all on any of these. Even energy transfer, which is one of the most searched stocks on the Zacks website right now, currently trading at around 1860, so sort of $18.90 or thereabouts. Year to date, it's up 35%. Most of the analysts are saying it's a buy, right? You just got to do a little bit of homework on this one. You can see what's nice about this one is the dividend has increased quarter over quarter every single time, right? And it's currently yielding around 7%. So just a few months ago, Energy Transfer was trading at around 12, 13, $14, right? So then at that point in time, it was yielding more than 10%. Now the stock price has gone up. So if you express the dividend as a percentage, it's 7%, but it's still pretty good, especially considering the stock gains of the last few months. The tip rank sky is expected to trade at around $20. So it's a little bit of upside from where it is right now, about 10, 11%. The nice thing about pipelines is it's basically contracted revenue and it's earned over a longer period, medium to long-term period, right? Those contracts are not attached or linked to the commodity price per se. So if you see the futures price for oil going up and down, uh, stocks like Occidental and Devon and even Petrobras to a lesser degree also just jump up and down as the futures price on oil goes up and down. The pipelines are less impacted in that regard because it's contracted revenue, typically easier to forward project and do a discounted cash flow than what you can do with a regular E&P stock. Oxy beaten down as well. It's down 20%. It was down 25%, but Uncle Warren actually increased his position in Occidental Petroleum. So if you want to follow him and you like what he's doing and you're prepared to buy Occidental for, 47, $50 or thereabout, you can buy some more. I was happy to buy it at 10, 12, $15. I don't want to buy it at $50. So if you hold it, as I said at the beginning, you have three choices. You can either hold it patiently and wait. Maybe Berkshire Hathaway acquires the company lock, stock, and barrel. Otherwise, you can add a little bit more if you want to reduce your cost basis. Or otherwise, if you were fortunate enough to buy into Occidental for, 10, 12, $15, you can sell it and, cash out and just pay tax on your gains. Most of the analysts also rank this one either a hold or a buy. Its dividend is nothing to speak of. It's been paying 22 cents per quarter, which if you express it as a percentage is only 1.9. So you're not buying Occidental for its dividend. You're hoping you can get an uptick on the stock price. The analysts predict the stock should be trading at about $60 from where it's trading right now. That'd be 27% higher. One or two of the analysts have even got it at $78. While we saw Occidental at $77 about a year ago, and now it's down to $47, so it's lost $30 from that last high. Who knows where it's going? I don't know. I wouldn't want to jump in here. Too risky. Right now, I don't know. I don't think so. I wouldn't buy. If you don't have a position at all, I wouldn't open a position in any of these. If you want to park some money into energy stocks, I might say, you know what, you can put a little bit of cash into Alliance Resource Partners. You can put a little bit of cash into energy transfers if you don't mind owning limited partnership units or shares. Otherwise, you can use my parking lot, which is XLE, right? It's the ETF. I'll tell you about that one in just a second. Petrobras down 18%. Now, this one at least pays a dividend, which is quite high. So you can almost say this is a wash. I'll show you that in just a second. The analysts are sort of undecided on this one. It just declared a nice big dividend for payout in January. So if you consider the fact that it's down 20% and the annual dividend yield with the dividend they've just declared is 20%, then it's a wash. In other words, you've just been treading water, but you haven't seen any growth. But look at the dividend decline since Lula became president, right? So we have the analysts saying there's a 30% upside here with a target price of around $17. We'll have to see if that holds or not. I don't know. This thing is volatile. In addition to that, you obviously have the Brazil geopolitical risk. You know what? I'm not comfortable with it, so I simply won't buy Petrobras right now. Maybe if it pulls back sharply and you can buy it again for like, $10 or less than $10, maybe I'll buy some. If I don't and I miss out on it, too bad. There's lots of other stuff that I can invest in. So let's take a look at this one, right? So a big one from a US point of view is obviously Exxon. In fact, if you wanted to just own one single stock and eliminate some of the single stock risk that you get with smaller cap players like Occidental and Devon, you could just buy Exxon and you're probably better off. Anyway, it pays a nice dividend too. And in addition to that, unlike most of the energy stocks, it's actually positive. It's green so far year to date, up just a little. Add the dividend to that. You're just plodding along. You're just below 10% sort of year to date, but it's okay. It's not too bad. Chevron is another one that you could potentially buy. I like Exxon more than what I like Chevron. You can also see it's my opinion is reflected in the stock price, right? So Chevron down 5%, but it pays a nice dividend too, right at the bottom of the screen. You can see, so it's sort of like my comment about Petrobras. It's a wash, right? The loss in the stock price, you've made up in the dividends if you earn the dividends. I much rather prefer this one, right? So this is XLE. XLE is the energy ETF. So it's an energy select spider fund. The cost of owning this is super low. They charge you an expense cost, your ratio, expense ratio that you have to pay, the fee that you have to pay for them to manage the ETF is 0.09%. So let's call it zero point 0.1. So 1/10 of 1% is your fee. It's not so bad. And it pays a dividend as well of around 3.5. So you can say I'm earning 3.5% as a dividend minus my management fee of 0.1%. So I make about 3.4% as a dividend. The stock has pretty much gone nowhere. It's got a all-star cast here of some of the best 10 companies in the United States. You can see the holdings here, 21% Exxon, 15% Chevron. Just a couple of months ago, these were at 2020, so 40% Exxon and Chevron. They basically made some adjustments, right? So and rebalanced, and it's a smart thing to do because what they did was they made sure that their largest position was in the higher growth rather than the lower growth big one, which is Chevron, right? So they increased their holdings on Exxon a little, but decreased their holdings in Chevron quite a lot. And then the rest of the companies here, these are superstars, right? Many times on the channel, people say, what do you think about Schlumberger? What do you think about EOG, etc.? Kinder Morgan, Marathon comes up all the time. ConocoPhillips as well, right? You can own them as a single stock. Otherwise, you could just buy this ETF. And of course, it's heavily weighted towards Exxon and Chevron. But these are great companies, man. 8% ConocoPhillips. Hey, you know what? You don't even have to do work here. You can actually be lazy, buy the ETF, pay the fund manager 0.1% for managing the fund on your behalf, and you are invested in some great companies. And if one of them pulls back like Chevron, the others are doing okay. So you're all right. I wanted to show you this screenshot quickly because this is a couple of my last videos that I posted on the channel. And one of them was the Trump effect on liquid gold. So I made a quick reference to it just a minute ago when I said, drill, baby, drill. All right. So if Trump says, drill, baby, drill, and Trump says, he told Robert F. Kennedy Jr., you take care of healthcare, but you leave the black gold to me, right? Those were Trump's words. So what I want you to do is to say uh, very cautiously, if I want to buy into energy at all, the mere fact that your incoming president coming in January the 20th, Donald Trump, is basically saying, drill, baby, drill, means he's asking for EMP producers to increase production. Many of them will just decline. They won't do it. Why should they do it? Because if they do it, they effectively are just increasing supply, which is negative pressure on the price for them. So, which is a negative pressure on their profit and on their free cash flow. So, why would they increase? But anyway, uh, Trump is absolutely focused on being energy independent, the US being energy independent. And to a large degree, the United States is energy independent, more or less. I mean, we import and we export oil and gas products, but we consume approximately 20, 21 million barrels per day. And we also generate or drill and supply about 20, 21 million barrels per day into the marketplace. But some of them are sold to other countries. And in the same way, the United States also imports from other countries, especially, for instance, Canada, which is one of our largest suppliers. I also made a couple of videos that you can look at here. I said there's 4 ETFs that you can consider for the Trump bump, right? We don't know where the institutional money is going to come into and which stocks or which sectors it's going to be invested into. And you don't want to miss out on that, right? So in a previous video here, it's only 4.54. So less than 5 minutes. You can watch this one. I was just recording it on the streets of Zurich, walking around, and I was basically saying, here's a couple of ETFs. The big one's VYM, which is a market ETF. The other one's SPY, which is more technology focused. but it gives you a broad base, almost like my example of XLE, which is energy. If you also invest in VYM and SPY, you're actually creating yourself a bit of a hedge because you don't know where the institutional money is going to go when Trump takes office, but there's going to be money coming into the market, and you don't want to be caught sort of flat-footed or be behind that potential surge. Just be very, very cautious with energy because drill, baby, drill might mean the opposite to what you hope it means because it means increased supply. I also made a video a couple of months ago saying a declining oil price, buy when others are selling and sell when others are buying. That's the sort of Warren Buffett philosophy, right? So he always says you should buy when others are selling and sell when others are buying. Now, currently, Mr. Buffett, who is much smarter than what I am, and certainly much wealthier than what I am, is buying Occidental Petroleum, and he's buying when other people, including myself, is selling, right? So he's doing exactly what he said he would do. But at the same time, I'm doing exactly what he said you should do, which is sell when others are buying. So I'm selling when Warren Buffett is buying, and Warren Buffett is buying when I am selling, right? So it's not that one of us is right and the other one is wrong. You just need to do what's right for you, right? So I said at the start of this video, I'm covering 5 stocks, and the 5 that I've covered in alphabetical order was Alliance Resource Partners, Devon Energy, Energy Transfer, Occidental Petroleum, and Petrobras. I also have a couple of larger positions in Enbridge, which is a Canadian pipeline company, and I also hold XLE. In fact, my largest position in energy is XLE. So currently I have 4 sort of, let's say, major positions in my energy portfolio, excluding uranium or nuclear. And those 4 would be Alliance Resource Limited Partners, Energy Transfer, which are both limited partnerships. As I said, complicating my taxes a little bit when it comes to tax filing time. And then the other 2 that I hold are XLE, which is the ETF, and Enbridge, which is the Canadian energy super giant, if I could put it that way. From a Canadian point of view, it's a very large company. So that's what I hold in my portfolio right now. If you hold the other 3, which I no longer have a long position in, so Devon, Occidental Petroleum, and Petrobras, as I said during the video, you have 3 choices. You can either do nothing, which is a strategy. In other words, I'm going to do nothing and wait and just hold it and collect the dividends because all 3 of those pay a dividend, albeit that Occidental Petroleum's dividend is really, really small. In other words, one option is to say, I'm just going to hold it and do nothing else and wait, right? And you just got to patiently wait because you might have another sort of medium term period that you'd have to wait for. So 3 to 5 years. The other option is to say my cost basis is much higher. So using the Warren Buffett example, his cost basis on Occidental Petroleum is about $60, but then he bought a whole, fistful at around $41, which caused the bump in Occidental yesterday, which went up to about $45, $46 because of Warren Buffett's buy, right? Because it was such a big buy. But what he did was he said, I already hold a very large position in the company at $60. If I buy another chunk of shares at $40, I'm kind of cost averaging down, right? So maybe his average cost basis now might be like, $55, $56 per share, which is a little bit closer to where it's trading now, which is like 45, right? So you can buy, and just like he did, you can buy just a little bit. You don't buy a lot. In other words, he didn't double his position. He just bought some more, which obviously has a positive impact on his cost basis because he's reducing his cost basis just a little. And the other option is to say, I'm just going to sell, right? I don't like to take a loss. So if you are unfortunate and you got into Devon Energy when it was trading at, $60 or $55 and now it's trading at $30, you don't just want to take a loss. And you might be forced to either do a little bit of cost basis adjusting, otherwise to just sit patiently and wait for it to recover because it will. We just don't know when, right? But don't expect the incoming administration. So when Donald Trump assumes presidency of the the presidency of the United States on January the 20th, don't expect an energy bump because drill, baby, drill is the opposite of an energy bump, right? So, guys, that's where I'm at, and that's sort of the roundtable on these 5 stocks. I'll make a video to follow this one a little later to share some of the mining companies that I found that might be of interest to you that you could add to your watch list. Until then, trade with caution and best of success. Take care. Thanks for watching. Bye-bye.